Welcome back to another video, guys. Today we're talking about something a little bit different. It's a viewer requested video and I wanted to jump in and film this as quickly as possible. So I'm going to go ahead and read the comment that kind of sparked this video and then I'll explain everything after that. So Mr. Richardson said, I'm a newbie and I would like to see your picks for the top 3 high yielding dividend stocks that are reasonably safe for principal. So this is a great question. It's one that I've answered on a couple different social media platforms, but I haven't done it on YouTube yet. And so I wanted to dive in and give you guys my top 3. So these, of course, are higher risk dividend stocks. Dividend investing is typically very safe, especially if you're buying a dividend stock like Johnson & Johnson or Pfizer, where the yield is below usually 2 to 3%. Those are safer bets, but these are some more aggressive, more dividend growth style dividend stocks, which I like. And personally, I'm on the younger side of the list of investors typically, so I like more aggressive investing. If you're a little bit older and just looking for some monthly income, these are still a little more aggressive, but I would kind of deviate and maybe buy some safer funds that are still yielding some pretty nice dividends, and I'll talk about one of those at the end of the video. So we'll start with my first 3. A big key thing that I like with dividend investing is diversification and dividend history, as well as the all-time chart appreciation. Now, there's definitely a mix of things that we'll talk about here. ARCC, we're going to start out with the biggest BDC, Business Development Corporation or company. I like this one specifically, and I think it is the safest just because of the sheer size of it. It is the largest. So unless it had specific bad news for it or the entire sector of BDCs started to drop, I think ARCC is the safest out of all of the BDCs. There is a BDC ETF called BIZD, which I do like as well because it owns some ARCC, it owns some Main Street, it owns a number of other ones, but it doesn't have the best price appreciation. So I didn't include that one because actually I think ARCC is safer to purchase just at this point. So let's jump into ARCC. We can see the first thing, their 1-year chart down about 10.5%. If we go to their 5-year chart, up 30%. So it's still been a very good 5 years. They were on a run. They were up 24% the first couple of years, 2 years prior to the pandemic drop, and are a little bit above that price, still about 5% above that. So it is getting into some more buying territory, and all time they're up about 30%. Now, people don't usually buy BDCs for price appreciation. With ARCC, the price appreciation is probably going to be a lot smaller than the smaller BDCs would be, but that's not why we own it. We own it because it has a nice dividend yield, and we'll look at their dividend yield right now, a nice 10.18% yield, which is good, especially for today. It's almost average with a lot of these higher yielding BDCs. An annual dividend of about $2 a share, so putting in $20, getting $2 back a share. Pretty good. Now, their dividend history has moved around a bit. It's been a rocky last couple of months, and I'll explain why. I've been following this one for a long time, but you can see they haven't cut their dividend since 2014, or they hadn't, I should say, because they did cut the dividend recently in 2019, and they actually cut it again in 2023. They dropped it down 3 cents. Now, ARCC, basically what happened was they were just way too hopeful. They put the dividend too high and then couldn't maintain it, so they cut it back down 3 cents. Now, people really didn't like this, but in my opinion, it's better for them to do that than to have too high of a dividend payout ratio and not be able to have a sustainable dividend. So they did cut it by 3 cents, and we can see that when they cut it in 2019, they cut it by 2 cents. So dividend cuts typically are not good, and I'm not happy about dividend cuts with ARCC, but I like that they are keeping it consistent. They're not cutting by large amounts, and they're continuing to grow it. Sometimes, yes, they make mistakes and they're a little bit too cavalier with it, and they do have to recoup that. But all in all, it's one of my favorite, and it is the largest, so you do get some safety with that. I have to say this in every video. Of course, guys, this is not financial advice. These are my favorites, and I do own all of the ones I'm talking about today. Next, we're jumping over to Realty Income. This is a really popular one that took off after the pandemic and basically hit $75, and it's come down a little bit, but the price on this one, 42% the past 5 years, and their max chart is insane. I love their max chart. This is what I really look for with dividend stocks. This one has a little bit of a lower yield. I think it's about 5%. Let me check. It was about 5% last I checked, but it may be up a little bit with the price falling. 4.4%. So it's actually a little bit lower, but that's not terrible. So 4.4%, this isn't like a high 10% yielder, but there are some REITs that do yield that. They're just higher risk. So if you're thinking long-term investing, Realty is the largest, is the biggest, the biggest position in my REITs out of all the REITs that I own. So it grew really nicely over time. It's great, in my opinion, to be able to get some nice dividends as well as some great appreciation with the price. Now, looking at their dividend history, a lot has been going on with the market, and they do grow their dividend pretty nicely. It's just a slower growth. So we can see they paid out cash stock in 2021 and have been growing the dividend up not even a full cent, but a couple fractions of a cent ever so often. Now, going all the way back, I believe their cut was in 2019. They do pay monthly, which is great. Yes, they're keeping it consistent. Keep growing, keep growing. Maybe it was the 2007, I believe it was 2007, 2008 when the market crashed. The housing market crashed, and no, they still grew it. Did they? Yeah, so there you have it. I couldn't even find a mistake in this. Basically just stating that they continue to grow their dividend, however, be it slowly. The price appreciation plays a big role, but it's a much safer stock, and that's why a lot of people have it in their portfolio. Now, this is like the REIT category that I talked about. So we have a BDC so far, we have a REIT covered, and we'll jump in. I like to have that diversification if you're going to put a certain amount of money into each. If BDCs start having a lot of trouble, let's say interest rates are changing, which they are, say they drop one way or another way, REITs will do a little bit better, and kind of vice versa. If we have another shutdown, REITs will typically do worse depending on the sector that they're in. If it's owning, retail stores, movie theaters, stuff like that, or if it's like just a strict rental income from people owning houses and renting those out, you have just a little bit more safety with that. So, and I again, if you guys are interested, I have full 5-minute DD videos on each of these. You guys can check those out and make your own decisions. Now, last but not least, we'll talk about a covered call ETF. There's a lot of these out there. Now, I chose the safest one. I do own XYLD. I think I own like 4 or 5 of the XY, QYLDs. And then there's JEPI and JEPQ. Both of those are newer. JEPQ hasn't even been around for a year, and JEPI's only been out for about 2 years. So that's why I didn't include those. Those are some of the most popular right now. But popularity does come kind of at a cost, whereas if they fall out of popularity and the income or the money influx goes down on those, the price can take a hit. And so when you look at QYLD, their all-time chart shows they're down like 30%. XYLD, their all-time chart shows that they're still up 0.9%. So we do see an insane drop, which I really like. There is a pretty bad drop 20%. And so this one, it does take a long time for these covered call ETFs to rebound. They don't reflect what the market's doing. So say we have an insane market run, these ones are not going to run quite like Tesla would, or Microsoft, or even probably JEPI if it got a bunch more inflow of cash. But it is important to note that these guys do pay out covered calls, and they do make that monthly income, which I really like. So looking at the dividend history, this wasn't working on NASDAQ.com, but I wanted to show the history of this one. So they have had some crazy spikes with the dividend. Now, covered call ETFs are not consistent dividend yielders. They're consistent dividend payers. So they do pay out a lot of dividends, but it's not always going to go up. So you don't want to say, oh, they cut their dividend. Now I'm not going to buy it, because their dividend bounces around all over the place. What I do like is their 10-year history. You can see the dividend has been increasing over time. If we go to their max, I think it's about the same as the 10-year. Yeah, they went from paying 15 cents monthly to now they were at 50 cents at a high and now 41. So it does move all around. But you're buying this for the dividend specifically, not for the price appreciation. That's why I love to do compounding interest with these, where I reinvest my dividends and they continue to grow. And as the dividend grows, you get more money each time, which then lets you buy more shares. And then if the price goes up, that's good, price appreciation, but you're not relying on that. And then lastly, I'm going to throw in just the number one safety play that I really like, and that's ticker SCHD. So I'm not going to put their dividend history up. They yield about a 3%. And their price appreciation lately has been going wild. So I usually I don't really count a lot of these years in the market, just because it hasn't been consistent. But if we go to right before the pandemic crash, it was up 132% from 2011 to 2019. So it's a good run. They pay a low dividend, but it's a safer bet. And it's one that I do own as well. It's my safe bet, basically, where I have a good amount in it. I'm not really worried about it, but I think it's important to have that just in case, say the REITs take a hit, BDCs take a hit, covered call ETFs start dropping in price. You always have kind of a safety play. And one of the most important things that I haven't really talked about on the channel is dollar cost averaging with all of these. If you're going to invest, say, $50,000 into each of them, do it over the span of a year. Put in however much you want to at first. You can start off with the bigger portion if you think it's a really good time to buy. Put in 10K and then put in 3 to 5K the next couple of months following that, just so you get a better spread. If it goes up, you're still buying when it's a little bit higher, but you started off lower, and if it drops down, you're recouping some of those losses by buying more shares and getting a higher dividend yield at the end. So that's where I'm going to end it, guys. Again, it's not financial advice, and I hope you guys found this useful, this video. I love making videos like these, and so viewer requested stuff, I really appreciate you guys dropping comments and asking me my opinion on stuff. I love to learn from you guys as well, so continue to do that, and I'll keep making videos about it. And again, I hope you found this useful. If you did, if you could like the video, that helps me out a bunch. Subscribing helps me out a bunch, and then commenting always helps the algorithm, and I'm here to learn as well as you guys, so I appreciate all of the kind words and everything, and the liking and everything like that. People have been great so far, and the channel's been growing quite nicely. So just wanted to say that at the end. Again, not financial advice. Final time I'll say that. I appreciate you guys for watching, and I hope you had a good day in the market.